Let's discuss Nvidia's stock today. The company has become the most valuable company in the world. I'll also show you the volatility that occurred after it became the most valuable company. We'll look at historical volatility, implied volatility, and market forecasts. Additionally, I'll show you a strategy that allows you to profit whether the stock rises sharply or falls sharply, meaning you make money regardless of the stock's direction, except within a certain range. Let's start from the beginning. We see that the stock has risen significantly over the past month, and this happened after a report with a growth of 50%. This is incredible. Honestly, I did not expect such growth. It's very, very substantial. We can track all the reports. As we can see, the report acts as a trigger for this stock. In May 2023, the stock rose significantly after a report, then consolidation started. The next growth spurt was after the November 2023 report, when the stock began to rise sharply again. After the February 2024 report, the stock entered a consolidation phase and remained in this range until the next report in May of this year. After that report, the stock rose again by 50%. So reports are really important to watch. What can we expect from this company now? It has reached a market capitalization of $3.4 trillion, which is incredibly large. The question is, can it reach $4 trillion? I speculate that this could happen sooner or later, but probably not in this growth cycle. I can suggest that sooner or later this impulse will end, maybe in a month or a few months. I'm not saying it will end today or tomorrow, but after this impulse ends, I fully expect a strong correction. The correction could actually be very substantial, possibly down to $50. Right now, this might seem incredible, but I'll explain why I think this way later. First, let's understand the volatility. As we can see, the volatility is at 50%, which is quite high. Volatility continues to rise. It seems the stock has been rising for a long time without any correction, and the volatility is also rising. This is actually a normal situation because volatility increases not only when the stock falls, but with any significant price movement. Currently, the price movement is objectively strong, so both the stock and volatility continue to rise. Let's look at historical and implied volatility. As we see, historical volatility is represented by the gray line and implied volatility by the white line. We observe that the implied volatility, meaning the volatility at the current moment, is much higher than its historical values. What does this mean? It indicates that due to the significant rise in the stock, the implied volatility has deviated from its historical values. This is a huge advantage for us. What I'm saying is that we can trade not only the stock, but also the volatility, and trading volatility can be even easier. Volatility always tends to revert to its historical values. For instance, right now the implied volatility is 50%, while the historical volatility is 40%. It's likely that the implied volatility will drop and return to its historical levels. The question is, how can we profit from this? The answer is that we can only profit using options. I can show you how to do this with an example. Artificial intelligence will help us. We assume that volatility will drop by 15%, and AI will construct interesting strategies for us. As we can see, the suggestion is to sell a put option with a strike price of $140 and to sell a call option with a strike price of $140. This is a typical short straddle strategy. However, this strategy is quite risky because if the stock moves sharply up or down, we could lose money. I showed you this strategy solely to understand how to play with volatility. Again, I do not recommend opening this strategy because it is complex and requires management. You need to think independently rather than relying on bloggers or artificial intelligence. You should understand how the market works yourself. We've covered historical volatility. Now let's look at the volatility smile. As we can see, the volatility smile is inclined towards both the downside and the upside. If we look at the near-term expiration dates, volatility increases in both directions. However, for longer-term expiration dates, volatility only increases towards the downside, indicating a fall in stock price. This is a normal situation because traders hedge their purchase stocks by buying put options. Now, let's switch to support and resistance levels. Here we see the trading volume of options. I recommend paying close attention to these values because they indicate where the stock might go in its support and resistance levels. We can see a large volume concentrated at the $140 level, which is the volume of call options. Currently, the stock has not been able to overcome this level due to this large volume, creating a significant resistance wall that is difficult to break through. We can see that the price has already failed to do so. But why is this volume so important? I'll try to explain using options and market makers as an example. I remind you that when you buy a call option, the market maker is obligated to sell you the call option. However, the market maker earns not from the options themselves, but from commissions and spreads. Therefore, they must hedge all these options. They hedge the sold call options by buying the underlying stock. The market maker purchases the stock according to a delta neutral strategy, meaning they buy an amount of stock corresponding to the option's delta. The higher the stock price, the higher the delta, and the more stock they need to buy. This creates a feedback loop. The more the stock price rises, the more stock the market maker must buy, driving the price up even further. Hence, it is not in the market maker's interest for the stock to exceed certain levels, as they would need to buy more hedge. If the stock doesn't surpass certain levels, the market maker can keep the entire premium, which is significant. This is why $140 is currently an impenetrable resistance level, and I believe it won't be breached anytime soon. However, it is important to note that a large volume is concentrated at the end of the week, meaning that next week, the options volumes will be in different places. Thus, the price might move higher or lower, which we must closely monitor. Now, let's return to the stock itself and what's happening here. I remind you of my philosophy: I cannot predict price movements, and I don't know where the stock will go. My main task is to manage positions wisely and build a portfolio in such a way that I profit in any case. By the way, I've started managing a portfolio from scratch, and you can see that I already bought a stock that grew by 6% today. You can check what stock it was. I also rely on mathematics and mathematical probabilities. Currently, buying this stock isn't in favor of the investor. It is evident that the stock has risen significantly. Yes, it might rise to $150, I'm not denying that. But in terms of risk and reward, it is not in the investor's favor. You must understand this. I'm not saying that the stock won't rise, I'm just saying that in terms of risk and reward, it's not favorable for the investor. That's the main point. I wouldn't buy it at this moment because the volatility is very high, making the insurance for this stock very expensive. What I would do instead is build an interesting strategy. Let me show you what it looks like. As we can see, if the price rises sharply, we make money. If the price falls sharply, we also make money. But if the price remains in the range of $115 to $160, we neither gain nor lose. This is an interesting strategy, but it involves selling uncovered call and put options, which means you can incur losses. This strategy requires active management, buying and selling options at the right moments. You can't just open this strategy and leave it. It's complex. This is how I manage my portfolio, by actively forming and managing it. Now let's look at the market forecast. This isn't my forecast, but the market's forecast. It provides comprehensive information, incorporating all available data. Again, if we look at all the stocks, the market predicts a decline for almost all of them. This indicates that the market is predicting a decline in stocks, likely due to an upcoming recession. I have already mentioned that I expect a recession by the end of the year, partly due to high interest rates, and I believe that giants like Nvidia could experience a significant drop. If we enter a severe recession, we might see Nvidia's stock fall as low as $50 or even lower, down to $30, closing the gap that appeared in May 2023. Some may say this prediction of an 80% drop is unbelievable. Yes, it sounds absurd now, but I consider it a possibility for the future. This won't happen in a month or two, but sooner or later I expect a decline. The hype around artificial intelligence will eventually fade, and I suspect that Nvidia's chips might not be in as high demand in the future. Of course, many might disagree with me, but this is my opinion. I observe how companies develop in cycles, and while Nvidia is currently in a very strong growth cycle, all bubbles burst eventually. I believe Nvidia could also experience a downturn. Additionally, I recently launched a new experiment, a portfolio from scratch. I've already bought the first stock for this portfolio. Check it out. I'm showing and explaining how I build a portfolio from scratch, what I buy, and what I do. Subscribe to the channel, and good luck to everyone.